thank you everyone for joining us today. We're very excited to welcome Peter Schiff, who's the Chief Economist and Global Strategist of Euro-Pacific Capital. He's one of the few widely known economists and investment professionals to have spoken about the financial crisis before it began. He's a widely followed opponent of debt-fueled growth policies and is known for his advocacy of emerging market and commodity-focused investments in countries with positive fiscal characteristics. Mr. Schiff, thank you very much for being here today.
Oh, thanks for having me, and thanks you guys for hosting the event. Figure I'm just going to set my timer here because I got 30 minutes for this thing, so I have an idea.
Yes, sir.
All right, start. All right, there we go. This will keep me aware of my time. Hi, everybody. Anyway, I've got up above my shoulder the logo for Euro-Pacific Asset Management, and my asset management company. We have been pending with IROC for God knows how long. I've been trying to get registered in Canada, but I think I am almost there. I think the last bit of information I gave them was hopefully the last. So when that happens, Canadians would finally be able to open up accounts with me, buy my mutual funds, have accounts managed through Euro-Pacific Asset Management in my strategy. So, make a note of that. That's the website. You can check us out if you want me to help you implement some strategies that would take into consideration what we're about to discuss right now, which is what's going to happen to the global economy, the U.S. economy in particular, the U.S. financial markets, the dollar, its status as the world's reserve currency, and what the implications are, not only for Americans, but for the rest of the world when the dollar loses that status as the reserve currency and it's replaced. I believe it'll be replaced by gold. But you need to understand the implications of that transition if you want to, have a good, investment return as this decade plays out. And I think a lot of the changes are going to happen over the next several years. And, a lot of the problems that exist in the global economy, in general, but in particular in the U.S. economy, those problems have been building for a long time. In fact, we've succeeded, unfortunately, in kicking the can down the road for many, many years, over a decade now, since the '08 financial crisis. And all of the problems that led to that crisis are actually worse now. The problems have been made bigger by the very policies that were supposedly implemented to solve those problems. Because we had a financial crisis because we had too much debt. And rather than eradicating the debt, we took on a lot more and we simply inflated a bigger bubble. The financial crisis really kicked off after the real estate bubble popped and people who had borrowed money to buy homes could no longer afford or no longer had the desire to repay their mortgages. And that had profound impact on the lenders. That caused the financial crisis. And of course, that dragged down the entire economy. But rather than allowing the bad actors to be punished, we bailed them out. And instead of blaming the Federal Reserve for inflating the bubble and blaming Fannie and Freddie for the moral hazard, we basically rewarded the government with more power. We rewarded the Fed with even more power. And so since then, they did a lot more damage. The monetary policy that existed subsequent to the '08 financial crisis, that monetary policy is far more reckless and has done far more damage than the policy that existed prior to the '08 financial crisis and which laid the foundation and caused that crisis. Now, the policy mistakes that the Federal Reserve has made since '08 were compounded since COVID-19. Right? The Federal Reserve, beginning really in 2015, in the fourth quarter of 2015, finally tried to raise interest rates up from zero and normalize them, something which I said from the beginning would be impossible. And that, that forecast was proven correct when the Fed was forced to abandon its efforts to normalize interest rates when they only got back to about 2.5%, which was about half of where they were before the Fed cut them to zero. And that really happened in the fourth quarter of 2018. That's when we had the worst drop in the U.S. stock market since the Great Depression on a quarterly basis. Everything started to implode. It would have continued had the Fed remained on its course of shrinking its balance sheet and trying to normalize interest rates. So instead, the Fed did a complete about-face. It started to cut interest rates, and it started to grow its balance sheet through the Fed funds market, trying to continue to artificially suppress interest rates because they had risen to a point where a overly indebted U.S. economy could no longer afford to pay. Even though the rates were still low by historic norms, the amount of debt was high, extremely high. And so you cannot afford a normal rate of interest on an abnormally large amount of debt. And so, the bottom dropped out and the Fed quickly reversed. And, people didn't really appreciate the significance of this. The Fed was kind of bluffing, calling it a mid-course correction. At the time, I said, no, the Fed is going back to zero. In fact, days before the final rate hike, I was on television in the U.S. Forecasting that the rate hike we were about to get in December of 2018 would be the last hike of the cycle, and that the very next move that the Fed would make would be a rate cut. I was one of the only people really in the financial community who was making that call. Most people expected the Fed to continue hiking rates. Nobody thought that not only would they stop hiking, but they would actually cut. And it turned out that I was right. They did that. And I also said that after they cut rates, they would return to QE, which they did. They didn't admit that until after COVID-19. Now, when COVID-19 hit and, the wheels fell off the economic bus and we plunged into recession and the stock market collapsed, that's when the Fed just went all the way to zero. They didn't pass go or collect $200. They just went straight to zero on interest rates. And they resumed quantitative easing with a vengeance. In fact, I already said from the beginning, from before the Fed even ended QE3, I said that QE4 would be larger than QE1, 2, and 3 combined. What I didn't realize is how quickly that forecast would come true because it's already larger. The Fed has already monetized more debt since it started QE4 than it did in the first 3 rounds of quantitative easing combined. That's because we had a much bigger bubble pop this time, and we are now, in the early stages of a much greater recession and a much deeper financial crisis than the one that we experienced back in 2008. But a lot of people still haven't come to terms with this. They still think that, we can get back to where we were prior to COVID-19, that we turned the economy off, and all we have to do is turn it back on again, and everything is going to be great. And if you listen to Donald Trump, we had the greatest economy in the history of the world before COVID, and we can just get right back there. That's impossible. We cannot go back to the way things were because the way things were was not normal. We were in a bubble prior to COVID-19. The bubble was already deflating on its own, but then COVID-19 put a gaping hole in it. It was another pin that caused the air to come gushing out. And there is no way to go back to where we were. It's like trying to unscramble an egg. It can't be done. We cannot reflate a bubble, nor should we want to reflate a bubble. Although that's not preventing the Fed from trying, because the Fed doesn't understand the difference between legitimate economic growth that comes from underconsumption, savings, and investment, and phony growth, a bubble that comes from inflation, money printing, artificially low interest rates. So the Fed is trying to get us back to where we were without realizing that that is impossible. Also the government is making horrific mistakes with the bailouts, all of the stimulus programs, the extended unemployment, the Payroll Protection Act, the CARES Act, this ridiculous HEROES Act, which hasn't passed yet, but we'll get something like that in the next administration. I assume that Donald Trump is going to lose. That's my, most likely scenario. But all of this government spending is compounding the problems, making it harder for the economy to recover, because government spending is a drag on economic activity. It's a drag on the economy. It represents a tax on the private sector. It's a transfer from the private to the public sector. Public sector is far less efficient. In fact, it's not even efficient at all. It's a complete waste. So we're taking resources that would have been used effectively, and instead we're having government squander those resources. Now, a lot of this is taking the form of inflation. People don't realize that the government is confiscating such a large percentage of the national income because they're not doing it honestly. They're doing it dishonestly through inflation. Right now, 55 cents out of every dollar the US government is spending, it's getting from the Federal Reserve. The Federal Reserve is printing 55 cents out of every dollar the federal government spends. That means the Fed is printing more money than the US government collects in taxation. So Americans are not getting more than half of the government for free. We're still paying for all this government. We're just paying for all this government through inflation rather than through more legitimate forms of taxation. But when governments fund themselves with a printing press, that's still a tax. It's just the government gets its purchasing power through an alternative route. So like when the government levies an income tax on its citizens and actually takes their money away from them, people have less money to spend because the government took it. And then the government gives that money to somebody else. And now that person who got the money can go out and spend it instead of you. So you buy less stuff, and that's making it possible for somebody else to buy more stuff, right? It's just a transfer. Well, when the government creates inflation, it's another way of arriving at the same result, right? So the government prints money and gives that new money to somebody else. You still have all of your money, but now that somebody else has money, but that other person didn't do any work, they didn't produce any goods or services, they just have money. And so when they spend that money into the economy, they're bidding up the price of the goods and services that you need. And so now the price is going to rise to the point that your consumption will be diminished the same way it would have been diminished had the government taken your money. But they didn't take your money. They left you with your money. They just took the purchasing power away from your money and gave that purchasing power to somebody else. So that is what's going on. This is massive inflation. The Fed is monetizing debt on an unprecedented scale. It's not just government guaranteed debt. When they were doing QE the first time or the first three times, they were only buying U.S. Treasury debt or mortgages that had been guaranteed by the U.S. government. So every debt instrument the Fed was buying was sporting a U.S. government guarantee to make good on the payments of the principal and the interest. What the Fed is buying now is municipal bonds with no federal guarantee. They're buying corporate bonds. They're even going down in credit quality. They're even buying junk bonds. But I would argue that a lot of the investment grade bonds that they are buying are actually junk bonds in disguise because Moody's and Standard & Poor's don't have the guts to put a real credit rating on these bonds. So they're leaving them at maybe BBB minus or the equivalent for Moody's. But an honest assessment of these bonds would put them in the junk category. And the only reason that a lot of these companies are not going bankrupt and a lot of these bonds aren't already in default is because the Fed is propping them up with artificially low interest rates and directly subsidizing the companies by buying their bonds. So the Fed is supporting this entire house of cards. Meanwhile, the underlying U.S. economy continues to deteriorate. It is a complete basket case now, not only thanks to COVID-19 itself, but thanks to the government's response to COVID-19, which has been even worse, which is doing more damage. This is certainly an example of the cure being far worse than the disease. You know, the monetary and fiscal policy is what's going to make the economy much sicker than COVID-19. I mean, first of all, we have highly incentivized people not to return to work. The majority of people receiving extended and enhanced unemployment benefits are being paid more not to work than what they were earning when they still had jobs. Well, most people don't want to work. They only work to get the money. Well, if you can get more money and not work, hey, that's a great deal. In fact, even if they extend the benefits but diminish it so that you get paid the same amount not to work as you were earning when you were working, that's still a powerful incentive because most people don't enjoy their work, especially if you're a lower income. You're tolerating your work because you want the check. If you could stay at home and just stay in your pajamas and watch Netflix and make the same amount of money as if you had to go back and forth to work every day, get up early in the morning, get dressed, commute into work, and do a job that you hate, and then come back in the evening, if you could stay at home all day and hang out with your kids or your wife, if that's what you want to do, or your friends, most people would choose that than being part of the rat race. So people are not going to return to work. We have tremendous numbers of people now that are just permanent wars of the state. But also, I mentioned that the financial crisis was kicked off because people defaulted on their mortgages. Well, now people are defaulting on a lot more than their mortgages. They're defaulting on everything. They can't pay their student loans. They can't pay their car loans. They can't pay their credit card debt. And it's not just Americans that can't pay their bills. Landlords can't pay their mortgage because they're not getting any rent. And even commercial landlords aren't getting rent. In fact, the whole real estate industry is imploding. Stores are shut down. Restaurants are closed permanently. They're not paying their rent. Clothing stores, movie theaters, gyms, all these companies are out of business. They're not paying their rent. The commercial real estate market is imploding, right? At the same time, the residential real estate market's imploding. This is a disaster. Look at the banks. The U.S. banks continue to weaken. They're the weakest segment of the market. The only part of the U.S. market that's going up is a handful of overpriced tech stocks that are being bid up based on cheap money and momentum, and a lot of shorts being squeezed out of their positions. But if you look at stocks that are actually trading on fundamentals, like the banks, they're a disaster because people buying them realize that their earnings are going to implode because they can't collect on their loans. The people they loan money to can't repay them. And the collateral behind those loans is collapsing. They can't make new loans because they can't make any money because rates are at zero. So the banks are toast. All these big banks that we bailed out after the last financial crisis are in much worse shape. People are downplaying this. They think the banks are in better shape. They're not. The banks are in worse shape. We're even more vulnerable now than we were back then. Except what's ultimately going to crush the banks is going to be when the Fed loses control of interest rates and inflation sends interest rates higher, because that's what's going to happen because of all the money that we're printing. Now, the QE 1, 2, and 3, that was also inflation. And that inflation was predominantly, held or stayed in financial assets. So the Fed inflated real estate prices, stock prices, bond prices. Consumer prices went up, but 2-3% a year, whatever it was, maybe more than that, because the Fed's method of measuring them isn't that accurate. But we didn't have a tremendous amount of increases in consumer prices, but we did have a big increase in financial asset prices. Well, this time it's going to be the opposite. It's going to be consumer good prices that are really going to go up. And the reason is going to be the dollar. The dollar is going to tank. Last time the dollar went up. And the reason the dollar went up is because the Fed convinced everybody that QE was temporary, that it was an emergency measure, that it would never be implemented again, that the Fed was going to shrink its balance sheet back down to where it was pre-financial crisis, that it was going to normalize interest rates, and everything was going to be fine. And the markets were dumb enough to believe the Fed. Now, I was warning for years that the Fed was lying, that what they were claiming they were going to do was actually impossible, that you cannot lever the economy up and then take away the cheap money and expect the economy that was propped up based on cheap money not to implode. I said it was like, getting somebody high on drugs and then denying them the drug and expecting them to stay high. It doesn't work that way. Without the drugs, you have withdrawal. And, the withdrawal started to come in, at the end of 2018. But what's going to happen now is nobody is going to be dumb enough to believe, even if the Fed is arrogant enough to pretend that the Fed could ever normalize interest rates, or that the Fed could ever shrink the balance sheet, which is now over $7 trillion. The national debt is $26.5 trillion, headed to $50 trillion. The balance sheet is headed up to $10-20 trillion. And if the Fed couldn't shrink a $4.5 trillion balance sheet, how's it going to shrink a $10 trillion balance sheet? I mean, it's not even going to try. I mean, it's worse than impossible. And if the Fed couldn't normalize interest rates when the national debt was $16 trillion, how's it going to do it when it's $30 trillion or $50 trillion? See, the more debt we have, the harder it is to raise rates, and the more dependent we are on rates being at zero. In fact, pretty soon zero will be too high. The markets, we have so much debt that we can't even afford zero. we're going to have to make rates negative. So this whole thing is going to collapse probably before we even get to negative. The bottom's going to drop out of the dollar because we no longer have the expectation of normalization of rates, of a shrinking in the balance sheet. People are going to realize that the Fed is locked in this monetary roach motel. They should have realized it when I first pointed it out, but they'll realize it now. And then everybody's going to want out of the dollar because we have massive trade deficit, massive budget deficits. You know, we have $3-4 trillion a year deficits, which will probably go up to $5 trillion a year plus in a Biden administration. There is no way the world is going to finance this. They're not going to divert all those resources so that Americans can have all this government for free. You know, the rest of the world has their own problems. The coronavirus or COVID-19 isn't just in America. A lot of other countries are dealing with it. They can't deal with their problems and our problems at the same time. So they're going to let the dollar go, and the dollar is going to collapse. And ultimately, that's going to send up consumer prices, inflation, interest rates here in the United States. And we are in for a rude awakening. You know, when the COVID-19 crisis first hit, right, a lot of the politicians were comparing this to World War II and like, oh, we're going to come together and we're going to beat this the way we won World War II, the way we beat the Nazis and Imperial Japan. We're all going to sacrifice and we're going to win this war on COVID-19. Except this time we're going to lose the war because we're not in a position to fight it. Because what our leaders don't understand is we actually did sacrifice to fight World War II, right? Nobody got a government bailout during World War II, right? You know, we actually raised taxes to finance World War II. We didn't cut them. In fact, in 1941, fewer than 10% of Americans paid income taxes. In 1942, better than a third of Americans paid income taxes. In fact, 1942 is when we actually started the withholding tax. We actually started taking income taxes out of people's paychecks. Before that, you only paid income taxes the following year. If you had income subject to tax, you know, let's say in 2019, you didn't send the government any money until April of 2020. But since the war was going on, they needed the money right away. So they started taking money right out of people's paychecks. Also, that wasn't enough. So the U.S. government started borrowing money from American people by selling them war bonds. Middle-class Americans, you know, loaned the equivalent of trillions of dollars to the U.S. government so the U.S. government could afford to fight the war. That's the opposite of what we've done now. The U.S. government has not raised taxes on anybody. And instead of borrowing money from the American people, the U.S. government is loaning money to the American people. The people aren't sacrificing anything. They're being rewarded. How do you have a war without sacrifice? They're just printing money. If we tried to fight World War II by printing money, we would have lost the war. We would have been over really quickly. We'd all be speaking German here right now. But instead, you know, we financed it legitimately. Well, we're not doing it now because we can't afford it. Americans are broke. They weren't broke in 1940, despite the fact that we had just gone through the recession of the 1930s. Middle-class Americans were in better financial position in 1940 after a decade of the Great Recession than they are today. Americans are completely broke. They have nothing. They're living paycheck to paycheck. That's why when people had to leave, you know, they were fired from work because of COVID-19, they couldn't pay their bills. Look, a lot of people lost their jobs when World War II started, but they didn't have a problem paying their bills. Not only could they pay their bills without a job, they could pay the government bills because people had savings. Look, you don't think restaurants and movie theaters shut down in 1941 when 16 million customers disappeared and went off to fight a war? You know, when everybody was sacrificing and paying higher taxes and buying war bonds, they weren't going to restaurants. They weren't going to bars, right? They weren't going to traveling and taking vacations. But none of the people that own these bars or restaurants got one nickel from the U.S. government. Nobody got unemployment benefits. We were a rich country. We had rich people. Now we're a country full of paupers. Everybody is broke, and the government is giving them money. But here's something that people don't understand. The government doesn't have any money. If the people are broke, then the government is also broke. Because while it's true that the people support the government cannot support the people. But we're pretending the government can support the people because we've got the Fed. We got the Fed printing money. But the Fed can only print money that has value so long as the rest of the world is dumb enough to hold dollars as a reserve currency. Well, my bet is our luck has run out. That we've now up the ante so much that there is no way. I mean, the world is going to back away from this. They're not going to continue. And you can see the dollar is already going down now. It's been a slow, steady decline. Soon it's going to turn into a complete collapse. But before that does, you need to get your financial house in order and understand what it means for the global economy. And I think when the dollar loses its reserve currency status, it's not going to be replaced by the euro. It's not going to be replaced by the yen or the Chinese RMB. None of those currencies deserve reserve currency status either. No currency should have that status. We need real money, just the way we had before the dollar became the reserve, and that's gold. And that's where we're headed. Gold's going to be remonetized. Gold hit over, we're over $1,800 an ounce, about a 9-year high in the price of gold. We're headed to 5,000-10,000, maybe more. We could go considerably higher. There's no way to remonetize gold in a meaningful way without gold being at least $10,000 an ounce, especially given all the money that's been created over the last decade. But when we go back to a sound monetary system, that is going to destroy an economy in the U.S. that is completely dependent on the reserve status of the dollar. That's the only way Americans can live beyond their means. That's how we can consume without producing. That's how we can borrow without saving, because the rest of the world produces for us. The rest of the world saves for us, and we just print money. Well, that privilege is going to come to an end, and we're going to have to deal with the consequences. But as investors, you need to know what's going to happen to asset prices in a world where the U.S. dollar is no longer the reserve currency and where American citizens are forced to live within their means. And that means that U.S. assets are going to be marked down considerably, led lower by the U.S. dollar. And on a relative basis, assets in other countries are going to increase in value. So what you want to do, right, is you want to get out of U.S. dollar-based assets before they're marked down and get into the other assets before they are marked up. So number one would be physical gold and silver. You want to own that pretty much instead of any currency. All currencies will lose purchasing power priced in gold and silver. So buy some physical gold and silver. We work with Canadians at Schiff Gold. Go to our website at schiffgold.com to get some physical precious metals. Gold stocks are going to kill it, in my opinion. I think we could see not only 10 baggers, but 20 and 50 baggers, maybe more, especially in the junior space. So you want to get in this sector. We've got separately managed accounts, and I have a mutual fund managed by Adrian Day. If you get in contact with us, hopefully any day we'll be able to take Canadians. I mean, we can take people all over the world right now, just not Canadians. But as soon as we get licensed, or as soon as we're approved, we'll be in all the provinces. You can open up an account with us. We can manage your portfolio in gold mining stocks, or you can buy my fund. I think our fund is going to kill it. We are a 4-star fund now. We had 5 stars. I started the fund, and we were the #1 fund in the category for the first 5 years that we had it, and for the first 3. I got an award from Lipper. We lost a little ground this year, and so that took us down from 5 to 4 stars. But I think we'll be maybe back on top by the end of the year. I think we got a great portfolio. I think Adrian's probably the best manager out there. That's why I hired him. He's been doing this 30, 40 years. Not many people can say that in this space. It's been such a long bear market in the mining sector. So not many analysts have stuck it out the way Adrian has. So I think we have a real comparative advantage in his expertise in this sector. But obviously, you can't have all of your money in mining stocks and gold. You got to have a more diversified portfolio. And so what my strategy is, I want to own predominantly equities because I think it's going to be a global inflation. All the central banks have printed money. So we're going to see elevated rates of inflation worldwide. I just think it will be higher in the US than in a lot of other countries. But still, I want to own assets, not paper, because inflation transfers wealth from creditors to debtors and from owners of paper to owners of real assets. So we're buying quality companies, utilities, property stocks, teleco, tobacco, some online type companies around the world that have good valuations, that are offering products and generating revenue in currencies that I think are going to retain their value much better than the dollar. So whether they're in Switzerland or Singapore or Norway or New Zealand or Hong Kong or Australia, I mean, there are places around the world that I think are in much better shape. Even Canada is in much better shape than the U.S., especially if I'm right on what's going to happen to gold and silver. There's going to be a mining boom, and so that's going to help benefit the entire Canadian economy, not just the mining sector, but all sorts of areas of the economy that will benefit from a booming mining sector. So you want to invest in assets that are countries that are going to be enriched. You want to align yourself with the people who are going to enjoy a rising standard of living relative to Americans who are going to suffer a diminished standard of living. So we set up separately managed accounts at Europe Pacific Asset Management. We will build diversified portfolios for you of quality stocks around the world in both developed and emerging markets. And I also have 5 mutual funds dedicated to these strategies. And again, these funds will be available, there's my timer, to Canadians soon. At the moment, they're available to everybody. But soon they'll be available to Canadians. Anyway, I want to thank everybody for attending. Again, it's Europe Pacific Asset Management. And don't forget to listen to my podcast. I do podcasts 2 or 3 times a week at schiffradio.com. You can also see them on my YouTube channel. Anyway, I don't think I turned my alarm off. There we go. Anyway, I think that's it, right? I'm out of time.
We do have time for a couple questions if you're interested.
A couple of questions. I guess I could take them. I just can't see them, so you'd have to read them to me.
All right. Is holding Eagles now at $1,912 a good deal, GLD or other for long-term hold?
Well, I just said, I think gold, you don't want to buy numismatic coins. You want to buy bullion coins, right? Coins that don't have any kind of special additional value because of their rarity or their appeal to collectors. You want to buy gold and silver that trade at a very, very small premium to the melt value of the coin. Because you don't want to be a coin collector in this environment. You want to be a gold and silver investor. But yeah, I think prices are headed much higher. But again, if you want to make the most money and you're willing to take more risk, then look at the mining sector. These gold and mining stocks, I think, have explosive potential.
Thank you. Will you be offering crypto assets to your clients anytime soon?
No, I will not get involved in gambling with crypto. I would discourage people from buying any of the cryptocurrencies, including Bitcoin. I suppose if you are only going to buy one, I mean, maybe that's the one. But I think they're all going to go down. So I think as a trading vehicle, if you're looking for something that you can trade and you're just getting in and out and you think you can get out before the bottom drops out. But personally, I'd rather, trade the mining stocks. At least in the long run, those are going to go up. So you don't have to get worried. You don't have to be worried about being caught long when the music stops. I do expect these cryptocurrencies to crash. I think eventually they're all going to go down to zero or pretty close to it. I mean, who knows if Bitcoin will get all the way to zero? It may have some small value as, people trade bankrupt stocks. They're worthless, but people still trade them. So there still could be a trading market. But I think that trading market will take place at a level much, much lower than we are now. So my advice to people with any crypto is get out. And if the reason that you own crypto is because you're worried about inflation and a weakening dollar and you want to hedge, then buy real gold. Don't get distracted by fool's gold. Buy the real thing.
Thank you. What are your short-term predictions for the Canadian dollar?
I think it's going higher. I think the U.S. dollar is going down against all the major currencies, and that would include the Canadian dollar. And I think a resurgent price of gold and silver, that will help the Canadian economy. I also think oil is going to come back when the dollar crashes, and so that will also be helpful. I mean, anything that puts resources back in play should be good for Canada. I think the emerging markets have the most to gain from the dollar's collapse. They've been under the most pressure from a strong dollar, and so they will get the biggest relief from a weak dollar. And I think those economies will boom, and I think their demand for resources will go up. And so whatever Canada doesn't sell to America, they'll be able to sell in Southeast Asia, and I think they'll do even better.
Thank you. What else besides mining might be useful to owning Canadian equities?
Well, I said, we own a broad basket of stocks that we consider good value. We have some online casino companies that we thought, represented good value. In fact, we recently took profits in one that had gone up about 6-fold in the last couple of months. So we sold one, but we're in that sector. But there are a lot of sectors. We own the tobacco names. We think they're pretty cheap. We're adding to our energy positions. I think that there's some value there. We were very overweight pharmaceutical companies. We've been lightening up a little bit there because they've done pretty well on a relative basis. But look, there are a lot of companies. Telecom, we're overweight. We've added to telecom. Those stocks, I think, are out of favor. They've been out of favor for a while. But a lot of the stocks we're buying are paying 6, 7, 8, 9% dividends. When bonds are paying next to nothing. So you're getting great dividend yields on a lot of these assets, and there's good valuations. Unlike the crap that people are buying in the U.S. that pay no dividends, and it's sky-high valuations. I mean, they're playing with fire. I mean, there's a lot of momentum, but when the momentum goes away, they're going to drop like a rock. So a lot of people who are in these stocks are waiting to lose a bunch of money. They just don't realize it. I'm waiting to make a lot of money. In the meantime, I'm getting paid to wait.
All right. Well, thank you, Peter. We really appreciate you being here today. It was a great presentation.
All right, great. Hey, thanks a lot, and look forward to anybody contacting us. There is a phone number when you go to the Europe Pacific Capital Asset Management website. You can get a number, speak to Raphael about new accounts. If you are an American, you can go to Europe Pacific Capital and you can open up an account right now, and you can buy my mutual funds either through my company, or you can go to Schwab, Fidelity, E-Trade, any of these discount brokers. All of my funds are on the platform. My gold fund, emerging market fund, dividend payers fund, value fund, and bond fund. They're all there. In fact, I think my gold fund is the fastest growing gold fund in the country. Our AUM has more than doubled year to date. And the majority of that is actually from inflows. Yes, the fund is up, but most of the increase is from people putting money into the fund. And so, the whole sector has been asleep for many, many years, and it's just starting to wake up.
All right. Well, thanks again, Peter.